A house that cost $50,000 in 1971 costs around $400,000 today. That has nothing to do with the housing market, my friend. It has everything to do with the dollar. Once you understand the effect of U.S. monetary policy on asset values, you'll never look at home prices the same way again. I'm Stan Brusoski. I've been in the mortgage business for nearly 30 years. Today I want to pull back the curtain on something that doesn't get talked about nearly enough. By the end of this video, you're going to understand why housing prices always seem like they're going up, why 2008 was a real crisis, but why everything's different now, and why waiting to buy is almost always a losing bet. We're going to cover some complex concepts in this video, but I think you're owed an explanation of what's going on, why it's going on, and why it probably isn't going to stop. So I opened this video the way that I did for a reason. Something happened in 1971 that's well known by the people who follow monetary policy, but it's a surprisingly well-kept secret to just about everybody else. So a lot of people don't realize that for a long time, the US dollar was backed by gold. So in other words, if you had a dollar bill in your hand, you could theoretically take it to the bank and exchange it for an equal amount of gold. Now that backing was one of the things that gave the dollar its stability, such as it was. And it was a major reason why the dollar became the world's reserve currency after World War II. It's the origin of the phrase gold standard. All right, now without getting too deep into the weeds, I mean, it's a great story for another time, but it's really not the point of this video. Suffice it to say that the US government thought that they could get away with printing more dollars than they had gold to back it up. Like a lot more dollars. And eventually our foreign allies started figuring it out. They started sending cargo ships to US ports with their dollar bills, asking to get their gold back in exchange for the dollars, right? And since there wasn't enough gold for that to be sustainable, President Nixon did the only sensible thing, and he took the dollar officially off of the gold standard in 1971. So no longer could you exchange your dollar for a like amount of gold, and no longer was the dollar pegged to a set amount of gold. And the result was immediate, and it was extreme. Gold prices soared in nominal dollar terms, as did the price of just about everything else. If you lived through it at the time, I don't need to tell you anything you don't already know. If you weren't around for it, well, the inflation of the 1970s is legendary, and frankly, it's something that we've talked a lot about recently in the context of today's inflation situation. Our government's had a complicated relationship with inflation ever since. The mandate of the Federal Reserve is to target a 2% annual inflation rate. So to put that into context over a long period of time, $50,000 in 1971 should be worth around $150,000 today if the Fed had been able to maintain that 2% target. Clearly they did not. Now the dollar's lost nearly 97% of its purchasing power since the Federal Reserve was established in 1913. One of the reasons for the big discrepancy is, well, every time we have an economic crisis, the Fed prints a bunch of money to bail us out of it. More dollars chasing the same amount of goods, well, that means prices go up. Turns out you can print dollar bills, but you can't print land. So incidentally, when prices inflate, the people who own assets get richer because their assets go up in value. The more assets you own, and the higher the inflation, the richer you get. That is not an accident. You want to hang on to that idea because it's a fundamental axiom of this channel. All right, so there's also a structural issue that affects US monetary policy, which is that we have an entire economy based on debt. Over $39 trillion in federal debt, and that is climbing every year. We've got another almost $19 trillion in consumer debt. Heck, the dollar itself is something called a debt instrument, right? When we say that the Fed prints money, well, it's really actually more accurate to say that it gets borrowed into existence. That's where all the US treasuries come from. Falling prices are more than just a problem for a system like that. They're a catastrophe, all right? So since we're talking about housing anyway, let's just use it as an example. Imagine how much of a problem it would be if a house that cost $400,000 in 1971 was worth only $50,000 today. Just turn the math around, right? You'd have people owing money on all sorts of things that aren't worth what they borrowed. So it's like, what's the point of paying back a loan that's several times the amount that your property's worth? Extend that across every sector of the economy, and a debt-based system dropping prices results in something called a deflationary debt spiral. It's more than just a theory. It happened between 1929 and 1933 when the money supply contracted 30%. 1/3 of all the banks went out of business. Unemployment was 25%. I'm guessing that those dates sound familiar to you, all right? The Fed was part of the problem back then in the 20s and the 30s. They learned their lesson. They got the message. That is never going to happen again as long as they maintain control of the system. The minute there's a systemic drop in prices, well, you better believe the printing presses are going to be humming at the Fed. So if we're talking about housing values and their inexorable increase over time, it's only fair to talk about the exception to the rule, which is the housing crisis of 2008. Prices fell as much as 35% or more nationwide. Millions of families lost their homes. It wasn't make-believe, it was a very real crisis. But there were some very special factors that existed then that were unique to that point in time. They didn't exist before and they haven't existed since. So again, without getting too much into detail, with the time that we have for this video, it really all begins with the Fed's bailout of the savings and loan crisis, the S&L crisis in the 80s and the 90s, and the bailout of the dot-com crash at the turn of the century. Alan Greenspan and the Fed had been printing money all through those bailouts, but they were managing things in a way that had the inflation that resulted going into the financial markets rather than really going into consumer prices. So we achieved something that they called a Goldilocks economy at the time, and it kind of looked like the Fed had finally found the magic formula to end all future economic crises. Because they were able to shield consumer prices from inflating, well, the inflation that was very much present, it had to go somewhere. Aided by bank deregulation, which loosened the rules on how banks could qualify borrowers, and the massive amounts of money looking for a place to go, well, real estate ended up being the answer. Home values had been steadily rising for decades. By the 1990s, interest rates had finally come back down to where buying a home made a lot of sense. In fact, buying a lot of homes made a lot of sense. As the real estate market heated up, well, everybody wanted to get in the game, and the banks wanted to find more creative and aggressive ways to qualify borrowers. It got to a point where if you had a decent credit score, well, the bank would just assume you were good for the money, and they stopped asking for income and asset documentation. I mean, it sounds crazy even coming out of my mouth, but I lived through it. I can tell you that's exactly what happened. Everybody wanted to be a real estate mogul. People talked about real estate the same way we talk about artificial intelligence now, with the same level of excitement and optimism. Housing only ever goes up in value, so what could be the problem, right? Well, it turns out the problem wasn't that house values went up. The problem was that they went up too much. Like, way too much. When that finally unwound, it started a collapse that went sort of viral through the entire banking system. There were billions of dollars of mortgage loans on the bank books that no longer had collateral to back them up. People stopped paying. Banks started collapsing. The Fed stepped in to the rescue, and guess what they did to fix the problem? Yeah, they printed money. Tons of it. Hundreds of billions of dollars. Does QE ring a bell? Quantitative easing, right? You may have heard of it. The end result was a housing bubble that burst, and while home prices dropped, you could argue that in some ways they really just dropped back to where they should have been all along if the bubble hadn't inflated in the first place. Yes, millions of families got hurt, but many more millions actually stayed in their homes and kept paying their mortgage, and by the mid-20 teens, their home values had really more than recovered and then some. The value of those same homes today are much higher now than they ever were at the peak of the bubble in the early 2000s. So in a way, not even the greatest financial crisis since the Great Depression could derail the steady rise in home values, even when housing was the epicenter of the crisis. The last thing influencing home prices today is a simple matter of supply and demand. Since the housing crisis, new home construction hasn't kept pace with population growth or household formation. The U.S. is estimated to be short some 4 million housing units or more as I record this video. Builders have their own problems that keep them from building more houses. Zoning and permitting issues, material and labor costs, supply chain problems, it's becoming almost impossible to build a profitable starter home in an affordable price range, so the homes you do see getting built are usually higher-end properties. Add to that, millennials are the largest generation in American history, and Gen Z is just as large and right on their heels. And as that population enters its peak buying years, well, there's millions of potential sellers sitting on 3% rates who refuse to move out of their homes. The supply and demand problem is a structural one. It may not be permanent, but it's long-term enough that it's likely to be another half-century before any meaningful progress can be made to address it. Bottom line, do I expect home values to continue to climb? Yes. Is it possible that they don't and they actually drop? Sure, but it isn't likely that that's going to happen again like it did in 2008. There's some pockets that saw, very aggressive appreciation during the remote work demand during COVID, generally beach towns and fair weather markets in the Sun Belt. And it's true, some of those markets are seeing price drops. But those are isolated microcosms. It doesn't reflect the broad demand for housing across the rest of the economy. Look, there's no guarantee that if you buy a home, it's going to go up in value over any specific near-term horizon. But investing in a home for your family historically has proven to be more than just a safe bet. Over the long haul, it's proven to be a fundamental and reliable linchpin in a family wealth-building strategy. We've covered it many times already on this channel. The median net worth of a homeowner in the U.S. is $400,000, while the median net worth of a renter is just $10,000. Those numbers look that way for a reason. Now, not everybody's ready to buy. I get it. Owning a home isn't the right decision for every person. But if you're someone for whom owning a home makes sense, well, waiting to buy is very likely just hurting you financially. If you want to find out whether buying a home now makes sense for your situation, there's a link in the description to book a time on my calendar. No obligation, just a conversation. I'm Stan Brusoski. Let's talk.